Welcome back to the channel. In our previous videos, we've covered the basics of investing, mutual funds, and stock market fundamentals. Today, we're discussing a concept that is absolutely crucial for long-term investing success: diversification. Diversification refers to spreading your investments across different asset classes, market sectors, geographic regions, and company sizes in order to reduce overall portfolio risk. By not keeping all your eggs in one basket, your gains and losses even out if any single holding underperforms. This provides greater stability and allows you to achieve your goals with less volatility. There are a few key reasons why diversification is so important. 1. Risk reduction. No one stock, sector, or asset class consistently outperforms year after year. Diversifying means you aren't reliant on any one investment. If one holding declines, others may rise to offset those losses. 2. Compounding returns. By reducing risk through diversification, you give your overall portfolio the best chance to grow steadily over time through the power of compound interest. Less volatility means gains have time to build on previous gains. 3. Unexpected events. Black swan events like the pandemic can devastate individual stocks or industries. But a diversified portfolio mitigates the impact of these unforeseen shocks. 4. Emotions in check. Concentrating in just a few holdings can lead to emotional decision-making if their prices fluctuate wildly. Diversification removes those emotional triggers. 5. Lowers overall costs. By accessing the entire market through diversification, you benefit from average returns at a lower cost than trying to pick winners actively. So, in summary, diversification is crucial for growing wealth steadily while avoiding unnecessary risks that could derail your financial goals. The key is spreading investments across different asset classes, sectors, sizes, and regions. There are a few main ways to achieve diversification in your portfolio. Step 1. Asset classes diversification. Diversifying across different asset classes involves allocating your investments among various categories such as stocks, bonds, and cash. Stocks offer growth potential but come with higher volatility. Bonds provide stability and income but may have lower growth. Cash or cash equivalents offer liquidity and safety. By having a mix, you create a balanced portfolio that can weather different market conditions. Step 2. Industry sectors. Spreading investments across various industry sectors helps mitigate risks associated with sector-specific downturns. For example, if one sector faces challenges, others may thrive. This diversification strategy ensures that your portfolio isn't overly dependent on the performance of a single industry, enhancing stability and reducing vulnerability to sector-specific risks. Step 3. Geographical diversification. Geographical diversification involves investing in different regions or countries. This strategy recognizes that economies and markets can perform differently based on geopolitical and economic factors. By having exposure to international markets, you add another layer of diversification. If one region experiences a downturn, investments in other regions may still thrive, providing a more globally resilient portfolio. Step 4. Individual securities. Diversifying within each asset class means not putting all your money into a single investment. For stocks, consider owning shares in various companies across different industries. For bonds, diversify across issuers and maturities. This approach helps reduce the impact of poor performance from one specific security. While individual securities carry risks, spreading your investments can enhance the overall stability of your portfolio. Step 5. Regularly rebalance. Regularly reviewing and rebalancing your portfolio is crucial. Market conditions and your financial goals may change over time. Rebalancing involves adjusting your asset allocation back to your target mix. For instance, if one asset class outperforms others, it may overweight your portfolio. By periodically rebalancing, you ensure that your investments align with your risk tolerance and financial objectives, maintaining the desired balance in your diversified portfolio. By following these steps, investors can create a well-diversified portfolio that is resilient to market fluctuations and aligned with their long-term financial goals. The simplest way to diversify is through low-cost index funds that provide instant exposure across thousands of holdings in a single ticket. Target date funds also automatically rebalance diversification for you over time. Some specific fund options to consider for a well-diversified portfolio include Total U.S. Stock Market Index, Total International Stock Market Index, Total U.S. Bond Market Index, Right Index, Commodities Index. Holding one fund from each category provides diversification across asset classes, market caps, regions, and sectors at minimal cost. Rebalance annually to maintain your desired allocation. Diversification is also important within asset classes. For example, a U.S. stock portfolio should hold S&P 500 Index, Mid-Cap Index, Small Cap Index, Growth Index, Value Index. This provides diversification across company sizes and styles within domestic equities. The same concept applies globally as well. By following these diversification principles, you give your portfolio the greatest chance of growing steadily while avoiding unnecessary risks. Remember, it's time in the market that matters most, not timing the market. Stay focused on your long-term goals and trust the process. There you have it, the essence of diversification and how to make it work for you. If you found this video valuable, don't forget to like, share, and subscribe for more financial insights. Stay tuned for our next video. Until then, diversify wisely and stay financially savvy.